All right, I'm going to hope and pray that that actually caught, um, that did not sync with my headphones because those are way in the other room, and hopefully that it's the speakers are catching my audio here. So let me see. Yes, so the first trade that we had was crowd. For those that remember, we actually had a diagonal setup on crowd where our short position was actually at that 500 strike. And because crowd was really pressing up against us, it was making it was difficult for us to keep making money on the trade. So we were going to have to come up with we were going to either have to close the trade or we were going to have to manage it. We decided to manage the trade so we could squeeze out more. Here you can see that 510 strike was for us a kind of a double top, but we did squeeze back up to it. For those that like the way that we trade or the way that we have conversations about trades, you do have this range at this zone at the top of the range, which is made to be liquidated. So we did come up to the 50%, pull back down, gave you the normal 1-to-1, and then we violated the entire zone. Now, on Friday, we did press up to the trend line, so we'll see what happens on Monday. But initially, what was happening to us is that because this short call was closer to the money, if I show you what it looks like at the end of to expiration, this peak in our position was actually like a little bit in front of us. So it looked, so essentially we weren't going to be able to see that 100%, well, that max profit, right? And the max profit potential on this trade is near $5,000. If you notice now, because of the number of times that we have moved that short position, we have actually taken in $17 of credit. So that's what the initial value of the short position was, plus every rule until now has given us that. And then our minimum profit at this point is that credit that we've taken in. So if crowd were to go to zero and our call lost all of its value, our short position has actually made more money than that long position was worth when we first entered, essentially. But now at this point, this call is obviously near the money and is currently worth by itself $5,000. So as long as we're paying attention to this trade and we can keep moving that short call out, we can let that long call go deeper in the money. Now, because of the fact that our expirations are literally like back-to-back months and there are no expirations between us since the CBOE hasn't rolled out any weekly trades, we did then add another trade behind it so that we're basically increasing our return potential back here. So by having the two trades, it actually makes, this kind of exponential return and then gives it a little bit of a smoothing out, but continual gains to the upside. So yeah, I can actually just draw that on. Let's just, yeah. So like here you see we have this and then we come down by adding the calendar back here. It actually allows this to kind of go like that. So we actually gain all of this in potential profits. So we obviously like to do that, especially because that position was extremely cheap to be able to add and will give us a lot of profitability up in here as the price of crowd continues to move up. Now we do want to be careful because of the fact that we are testing the trend line on that Friday news. So now let's see our other trades. So yeah, that was a massive win for us and has just continued to be a strong win for us. So congratulations to those that took profits. OSCR was extremely interesting. So normally, once my calls are super deep in the money and the short positions are out the money and have expired, usually I just keep adding short calls. But with OSCR, we did allow our short calls to expire out the money last week. So we got a 100% decay on those. And we kept our long calls that were going very deep in the money. We allowed them to get naked and then we held them over the weekend. And that was a great decision. We were up 10,000%. We've made $250 on this trade. And the key thing you have to remember is that all of those shorts also garnered us other money. So we made on those calls like this $250, but on each of our shorts that we've been rolling out week after week, plus the short puts that we've had many weeks, not every week, but many weeks, we've totaled over $1,000 on the positions, depending on how much you scaled up. That obviously could have been, you know, three, four, five, $6,000. This return is only on one contract. So for people that have accounts over $10,000, you should have been able to lean into this trade a bit more aggressively and be able to take multiple contracts. So congratulations to those that won. What is very nice is that oh, did my trading view decide to go to sleep? That's not nice of you. Trading view. Oh, there you are. So the nice thing about Oscar is that on Friday with that news, it did have a massive pullback, which we were glad for. It allows us to be able to kind of consider if this bullish zone holds. It was an unmitigated bullish zone after this long rounding. So if it does come back into us, then we could see another move up. But we do need to see how the market digests this China news before we get gangbusters and just start leaning into everything. That's not necessary. APLD has done amazing. APLD had earnings this week. I did signal to the group that if APLD is bullish, that will be great for all of our positions, except it will be a little bit difficult for the short straddle. So I suggested that if people wanted, they could manage that because it was green before the earnings news. And then all of our other positions, the short put decayed 100%, and we did close that in the short weekly puts. And our diagonals have all done extremely well, and we were able to manage some of those short positions going up. But if you kept the short straddle on, as it is, of course, your shares made over $650 if you bought the 40 shares at the last price. If you bought shares when we were initially signaling, then you're up, more than that. You'd be up easily $2,000, $3,000 on shares because we initially started entering APLD down at the 16, 17, 18, and obviously it went all the way up to almost the 40 strike on earnings. So congratulations to those who were in shares. Congratulations to those who were in the other positions. And this short straddle, when we were up at that 40, was struggling to be green. But actually now that APLD has had a nice little pullback here, yeah, we are back on sides with this trade. And with the China news, we'll see if that continues to close the gap, which would be perfect for the short straddle and for some of our other positions where our short calls are a little bit too close to the current price. Baidu, that was up 80%. I did signal that gamma was still in place, but weakening. We did tap the gamma strike we were looking for, so that was the right time for people to consider taking profits if they're especially if they're in a small account. So Oracle, that has done amazing. The key thing for us again here is, as you can see, our short call was closer to the current price, and the long call was further out the money at the 320 strike. We have this space between our strikes, which is super nice. This position only cost us $240 to get into. The magic is that this short call is not dragging us. We can actually, if we wanted, we could even move this short call out to the 330 or to the 340 without having to pay anything to do that, and to allow this long call to just be naked. We did manage it a little bit differently than that. Just that that we were taking some profits on some positions surrounding Oracle. What helped us is that Oracle actually has pulled back into the gap. So originally the stress factor of this was that Oracle was so close to our gamma squeeze, which we did not really, that we didn't have so quickly. We were expecting that to be after OPEX and after earnings, but that actually popped a bit faster than we expected. But it didn't hold because that's not also how the gamma was set up. The gamma was expecting that we would come back into the gap before taking another launch at the squeeze. Friday news, you can still see that we were holding this bearish bullish position. So we'll see if we can maintain this upward trend line for our strikes. IREN was also up gangbusters. And so we needed to manage this position. As you can see, it's up at the 57 strike, and our calendar call spread is here at the 45, and our put spread has decayed to nothing. So what we did is move up the put spread, and then we moved up the put spread to take in another $3.60 of credit and then allow ourselves to manage this trade. Now, what we did in order to manage this trade is something really interesting. So as you all know that, where are you? Option strat. So here's the thing, right? When you're in a calendar spread and you are, let's say for instance, like with this, let's say that we never managed crowd and crowd was already up at like the 550. So price, we didn't manage this, we kept this here, and then price moved all the way up to the 550, and all of this is now in the money. And as you can see, we're not making as much money back here. But with IREN's position, it gapped way up. So it would have been more like way back here, which would have meant that we were making significantly less money than what was going on at the peak. So essentially what you want to do, or what you could do, and what we decided to do, is instead of moving the short call, we left the short call where it was, expecting that we could, on IREN, get a pullback. So our expectation is that though the price is like way up here, relatively speaking, since this is the crowd chart, that the price can come back towards us. And then that will allow us to make more money in this part of the P&L graph. So what we did is that in the event that IREN decides not to do that, and it just digests around here, digests around here, digests, and never comes back to us, then of course we're not making any extra money by holding this position. So in order to make more money holding this position, we laid on top of us, a put credit spread down here, and we took in credit. The reason that we did that is because by laying that put credit spread on top of the calendar spread, if the price chooses to digest up here, then no problem. That's going to decay and give us money. At least we're making money from the time that we're like waiting to get back to the max profit. Then the other thing that it does is that if we prove to not come back down, but it looks like we're consolidating to make another leg up, the money we've made from this put credit spread, we can use to move that short call further away from us. And then that allows that long call to get deeper in the money. Or the price actually does decide to come down, and it does come down into that peak area of profit, we will lose a little bit of money on the put credit spread, but it will be an irrelevant amount of money compared to the money we will make on the call calendar spread once the price comes down to us. Because as you can see that at these peaks up here, that is an exponential return. And with put credit spreads, you already know what your max loss is going to be. So if we actually look at, if we go back and look, you can see that our max loss is $600 on that bull put spread, but we are making $400, which is a lot of money for a stock that's barely 60 bucks. But the benefit is that if the price comes down towards the 45, we will easily make $2,000 on that call spread. So we are risking about $600, in order to make $2,000. Either way, we're going to make money. We're either going to make $360 because the price never comes all the way down to the 50, or we're going to make money on the call calendar. And so that's kind of oftentimes that is a trade management rule that you should always consider when you're in positions, especially if you've had a lot of time decay on them and you're really looking at a high profit potential. Like here, this 45 call spread by itself could hit $2,000. So we don't want to close a position at $300 when in fact it's actually could be worth more than that, right? So you always want to think through those things when you are managing trades. Now, CLSK, that's also done gangbusters for us. We are inside this call credit spread and our short put has decayed to nothing. So we have just moved that up and we have adjusted the call credit spread. As you can see here, we're up 1,500% on this position. That is not including all the extra credit we have taken in along the way by moving out that short call, because actually originally when we entered it was at the 10 and we have moved it out with time and moved it up. So we've continued to make money on that short put as we've waited for this call diagonal to give us some exponential return. Then we closed a position also on IBM. Depending on when you close the position, you were up 100%. Now, yeah, it was, and then it went flat at the end of the week. So if you were able to close at the 100%, then, congratulations. If you held it until expiration, then of course it didn't expire. It didn't perform for you. One of the things you always want to pay attention to is that when we have 2 or 3 positions on and they're layered, you want to know if one is acting as a hedge for the other. So with IBM, when we created that position, I did signal that I was using this call calendar as a hedge to another position in case IBM moved really fast, which it did. But if you're using your call calendar as a standalone position, then you do need to manage the profits differently. And as we always say, if you're taking these trades, these smaller trades, you want to really pay attention to how it's interacting with your entire account so that you can rinse and repeat the profits. You will rarely be wrong for just consistently taking your 100% and then flipping them into a different position. We had a lot on AMD that did phenomenally well. Rigetti has also been doing extremely well for us. Again, our calls were super deep in the money. There was no reason to keep holding this position. Even though obviously we had until 2027 on those long calls, the reality of the situation is that they were already at a 90 delta and you just don't have any more leverage. At that point, you should just decide, do I believe that Rigetti is going to keep being bullish? Should I just buy 100 shares at the 20 and then just have those for the rest of my life? Or do I not believe that Rigetti is going to continue to move up and I might as well just take my profits because I'm already up $25 a share on those long calls. So, yep. So our Uber short calls, those have all expired out the money. So we got 100% return on those. Datadog has continued to do really well. Again, because of the fact that the market has just been really overextended, I did signal to people, yes, we haven't hit quite 100%, but we've been in these positions a while, and 80 and 75% return is quite, is a decent ROI. So especially if you're scaled up on shares, scaled up on the positions, because with a lot of diagonals, people do scale up because they are quite inexpensive, relatively speaking. And you can maybe get 5 or 6 or 10 or 20 or whatever. So, if you had done this in size, you would already be up, 100, almost 100% on 10 contracts. So that's nothing to sneeze at, right? So, yeah, APLD, we were deep in the money, taking profits, managing trades. Again, the short puts were worth nothing. We sold them at 35 cents or $35 a piece, and they were 3 cents when we closed them. Our covered straddle was up massively going into earnings, and I did signal to everyone that if you're happy with these returns, close it, because I mean you're going into earnings, and why. So, congratulations to those that had that diagonal call. And yeah, you were up 160%. Your shares were up $670. The covered straddle then after earnings was slightly red. VRT, this has also been a really great position for us. Our short put, we actually did a short put leap because we just were so convinced about the overall bullishness of potential bullishness of VRT. We sold that obviously out the money, but that was already up $400. So I did signal that we needed to adjust this because it is just too far out the money. And it's not really, now we're not really doing much with the time, right? It's already decayed more significantly. And the diagonal call that we have is also up. And you can see that it is slowly losing a bit of value. And part of that's because VRT is way up towards our short position. So again, that's where you want to start managing your diagonals and calendars. And we did do that. So I hope you guys had an amazing week. Again, these, nothing to sneeze at, 130%, 60, 70%, 160%, or I think I already said that, 90% decay, 150% up here, plus all those short puts we were making money on. Oops, it's not going to let me. Nope, I don't want to keep. I want to close you. Yeah. Then DDOG 80, 75%, Rigetti 220%, the other Rigetti position 120%, or this was 210%, the other one was 190%, or sorry, yeah, 190%. AMD was also up massively. CLSK up 1,500%. The other CLSK up 700%. That's not including all the returns from all the short puts that we had. The IR yen is up 400%. Oracle up 130%. APLD up all kinds of percent. So, and then the fact that all of our systematics were working, I hope you guys are letting these trades bake, get the returns, you're managing them. And if you have any questions, always ask the questions, please, because if you're not getting the same returns that you see here, it means something isn't exactly right. And that's totally fine. We just don't want you to stay at it's not exactly right for a really long time, because it means that you might not necessarily be making those compounding returns. And we want to make sure that we're all winning together. All right, friends, I will see you tomorrow in the Discord, and I hope you guys have a great Sunday. Bye for now.